Jai Hind dosto, welcome to FinVision. I'm Colonel Sandeep Melwar, and in continuation with our series of financial awareness videos, today we have come up with another important aspect, that is SIP or lump sum. Which mode of investment is better? And today we will solve this dilemma of yours by giving you the data that which mode of investment performs better and which one fetches you higher returns. SIP or lump sum. In the market, basically there are two modes of investment, that is lump sum, also called as bullet investment, wherein the entire investable corpus is invested into the market in one go. SIP, also known as systematic investment plan. In this mode of investment, a fixed amount of money goes into a certain set of funds on a fixed date of the month. There is also one more mode of investment, that is STP, wherein the entire investable corpus initially get invested into a safe debt fund, and from that safe debt fund, the amount is gradually invested into the equity mutual fund. Many investors believe that SIP is the best investment strategy, and the logic given is it averages out the purchase price and will always earn higher returns. Yes, SIP does averages out the purchase price, but it doesn't always give you high returns. Let us see this with some data. Suppose you had invested for 7 years and you started investing in October 2008. This is the graph of the Nifty during this period of 7 years. Suppose you had invested in the lump sum in October 2008, you would have seen a growth of 19.8% per annum. But had you invested through the SIP mode of investment, your returns would have been at 13.46%, because you can see you started investing almost at the bottom of the market and market kept on rising thereafter. Does that mean a lump sum is better than SIP? Have a look at the another data of the same period. That is, herein, suppose you started invested in January 6, 2008 and you remain invested for next 7 years. So this was the journey of the market during this period. In this period, had you invested in lump sum, you would have received gains of 4.9%. But during the same period, the SIP would have yielded much higher returns of 14.22%, because you started investing at the high and market kept on moving down for some time thereafter, and then it started rising. Therefore, your average price was down and you fetched higher returns through the SIP mode of investment. Let's have a look at the same from a recent data, and this time from a FinVision investor. An investor approached us in June 2020 and he had an investable corpus of 6 lakh rupees. Remember, that was the period when people were very apprehensive about investment because COVID crisis were almost at the peak. But the investor listened to us and invested the entire 6 lakh rupees in one go. So this was the journey that he had seen. The invested corpus of 6 lakh rupees in 1 year rose to 9.13 lakhs. Had the investor not listened to our advice and had he gone for a SIP investment of 50,000 per month for next 1 year, his corpus would have just grown to 7.38 lakh rupees. So in this period, by investing through lump sum, the investor got 1.74 lakh rupees extra in gains in just 1 year. What does the data indicate? This data indicates that in an uptrending market, bullet or lump sum investment in one go fetches you higher returns. So when does SIP or STP fetches better returns? Have a look at this data of 20 years, wherein an investor started investing in 1999 and he invested for next 20 years, that is 240 months. In this period of 240 months of investment, there were 86 months of market trending down, wherein the amount of corpus invested in these 86 months was lesser than the bull phases of the market, which were the market kept on rising for 154 months. So as a result, in this period of 86 months, the amount invested was lesser, but still the investor got more number of units. Therefore, his average purchase price came down. Thus, the SIP or STP mode of investment is more efficient in the bear phases of the market. And this is the reason why we at FinVision have been recommending a staggered or a SIP mode of investment throughout 2022. Here are certain benefits of SIP which you should take note of, and you should utilize them for your benefit and creating a larger corpus. That is, SIP is extremely useful, but it doesn't guarantee better returns, because returns are a function of market conditions. And in case you are investing in the bear phase of the market, SIP will be beneficial, and in the bull phase, lump sum will give you better returns. SIP offers you a convenience and helps you inculcate disciplined investing, and which is very important for long-term wealth creation. Many investors keeps on waiting for the right time to invest. SIP helps put an end to this timing game. Therefore, you remain invested in market and you fetch better returns. It helps you invest based on your cash flows and not trying to time the market. Which mode of investment should you choose for better returns? Here's the chart which shows that the major driver of investment returns is your right asset allocation. Timing just contributes less than 2% of the returns on your investment. Therefore, for optimum returns, invest through a right asset allocation strategy. If you have the money, don't shy away from lump sum investment. In long term, your money is better off in market than in your bank account. Decide on your goal, decide on your risk appetite and asset allocation, and invest in one go. In case you have regular income and want to gradually create a bigger corpus, there is no better mode of investment than SIP. The takeaways: SIP and lump sum are merely methods of investment. None of these guarantees better returns. If you have the money, decide on your financial goal, investment horizon, and asset allocation, and go in for a lump sum. Still apprehensive about the market, and to cushion your entry into the market, STP could be the another option, wherein you invest the entire investable amount into a safe debt fund and thereafter take gradual exposure into aggressive mutual fund scheme. Remember, wealth is created by investing through right asset allocation and participating in the entire market journey. Time in market is more important than trying to time the market. Don't forget to like, subscribe, and share our channel with friends. Till our next video, thank you and wish you all the best. Happy investing.